Max Gagliardi, and you're listening to the Talk Energy Podcast. If you're watching this video, take a moment, hit the subscribe button on YouTube, or you can follow us on your favorite podcast app. If you're interested in even more energy content, you can go to Substack and check out our energy company's Substack newsletter. That's Ancova Energy, ANCOVA. Lastly, I want to talk about Woodworks Distilling. We recently partnered with an amazing management team here in Oklahoma City to open up a new distillery, and these guys are making some incredible craft spirits. Currently, we've got 1 vodka and 2 gins that are out on the marketplace. You need to check them out. They're super smooth, and they're really unlike anything that's out there. If you're listening to this on the podcast app, you should switch over to YouTube so you can see this bottle. The labeling is amazing. These guys have done such a good job. We're really excited. Next month, the bourbon and the rye will be available. If you're interested in checking it out, you should follow those guys on Instagram. That's Woodworks Distilling. They have all the locations where you can purchase it, or you can come down to the historic Britton District to the distillery itself, and you can buy the bottles there. There's also a bar. You can hang out. It's an event center. Excited about what these guys are doing and think it's going to add a lot to OKC. This episode's guest is Jeff Krimmel, the Chief Strategy Officer for Pinnacle. Jeff consistently puts out these really well thought out research notes on his LinkedIn page, covering everything from macroeconomic trends to oil and gas market commentary. This episode, we discuss the current macro environment and the forces that are impacting the economy. We talk about everything from inflation to interest rates and all the things that Jeff is paying attention to. The back half of the episode, we get into the U.S. energy and power markets and the changing global energy landscape. And lastly, we hit on some of the other major headlines in corporate America. Hope you enjoyed the show. Jeff, welcome to Talk Energy. Thanks for coming on.
Thanks for having me, Max.
You're the Chief Strategy Officer at Pinnacle, and that sounds about like the coolest role that I can imagine. Like when I'm really into the macro stuff. Obviously, I'm into energy. I'm a hobbyist around reading and consuming as much of just the kind of macro and intel stuff. I try to stay up to pace with everything that's going on. And so that just sounds like an amazing role, and I'm excited to have you on. Maybe just start off by introducing yourself and talking a little bit about what you do.
Absolutely. Well, again, thanks for inviting me. This is a lot of fun to do. My job is great. The title, I think, does accurately reflect kind of how cool the different bits and pieces are that I get to work on a day-to-day basis. And I actually got to this kind of work in a very unexpected way. My background is all in mechanical engineering. I have a bachelor's degree, master's degree, a PhD, all in mechanical engineering. And as I was getting those degrees, I was, of course, thinking, I'm going to have this sort of long, research and development focused career and this highly technical pathway that I'm going to follow. And that lasted for about all of 15 months. After I defended my PhD thesis, I defended that in 2010. And in the summer of 2010, I started working at Baker Hughes. And for about 15 months, I was in a research and development role, in a new product development role. And it was great because it was, I was working with some high-powered engineers and using the kinds of tools I was used to using and thinking about and working on when I was a graduate student. And so I was getting my legs underneath me, if you will, around, okay, how does an industry research and development engineer function? That lasted, like I said, 15 months. And then an opportunity came available through what they call the Science and Technology Leadership Development Program. And so there was a group of 6 of us early career PhD scientists, engineers that got kicked off into that leadership development program. And I won't bore you with all the details there, but that's how I got into some data-driven pricing and profitability work and some strategic market intelligence. And as I was getting into that stuff, my claim was, hey, these the tools that I've learned how to use in the course of my engineering career, I'm just using these same tools, but deploying them in an unexpected way, right? And for a lot of these science and technology problems, you're working from first principles. You have a pretty rigorous foundation off of which to ask some interesting questions and try to pursue these answers. And so now I was steering it toward sort of market-facing endeavors where there really aren't such things as first principles that hold rigorously in all contexts. Yeah. And it requires quite a bit more art and nuance and assumption, and reasonable people can disagree. But it was a fun way for me to use some of these tools and steer them in a new capacity. And so that is how I've ultimately found my way into this chief strategy officer role at Pinnacle.
Tell me a little bit about, and tell the listeners a little bit about Pinnacle and what your company does. And then after that, we'll, and I'm just curious because I know a little bit, but I just want to hear some of that, and then we'll launch into the discussion.
Absolutely. So Pinnacle is an industrial reliability services company, and we're headquartered in Pasadena, Texas, just outside of Houston. And the easiest way to think about what we do is we help complex process facility operators. So things like petroleum refineries or mining operations or petrochemical plants or wood product manufacturing facilities. We'll help any of those folks figure out how to inspect and maintain and operate their equipment in the most reliable way possible. And we use a lot of data to do this. There's a lot of data that customers have. There's a lot of data that we can collect that they might not otherwise have. There's a lot of reasonably sophisticated analyses that we perform to try to really understand if we're going to go perform an inspection or if we're going to go perform a preventive maintenance intervention. What is the value of that intervention? What would we expect the reliability performance to look like on the back end? And so what we do is we partner with customers that certainly know how to operate those plants, have incredible intimacy with the equipment itself, and then we help them organize data, go collect new data, run the analytics around it to find the optimal way to intervene to get all of that equipment to run reliably.
That's awesome. So it's you've got a lot of industries. I'm guessing that you guys touch. There's probably a lot of considerations around what's going on in the economy, what's happening at the macro level, and so from the research that you put out and the notes that you put out, you're clearly focused on and have your finger on the pulse of a lot of different things. And so that's why I was excited about this episode, because you're putting out research pieces on everything from Disney's new CEO to oil field worker shortages, to wind versus natural gas and costs there, to the macro economy. So I've got a whole list of things, and we could probably easily fill up an hour, so let's just launch into it. But just want to start with just your thoughts on this economy and coming out of the COVID crisis is what I'll call it, because it definitely was one. And there was just some pretty historic things that happened around the economy shutting down, interest rates going to zero, Jerome Powell saying, I'm never, we're not even considering raising interest rates for the next 4 years. And then now they've raised interest rates at one of the most rapid pace of rate hikes that's ever happened. And so I'll let you riff kind of high level on your thoughts of the state of the economy and what you're interested in looking at, and then we'll get into some of these more specific topics.
Certainly. I think it'll help if I give a little context about my, the lens through which I view this, or why I'm motivated to spend my time in this area. And one big reason is, what we do at Pinnacle, like I said, on the industrial reliability side. An important bit of the conversation we always have with customers is the value of reliability, really understanding what is the value of having equipment operate even more when you expect it to operate even closer to sort of the expected levels of throughput that you have for that equipment. And that sounds, those are easy words to say. That sounds like an easy conversation to have. It's actually really difficult because reliability doesn't receive a ton of attention. It's not the sexiest of topics. And what I have found interesting, and through my own conversation with the customers, what I found resonates is the value of reliability. And I was surprised after I started diving deeply into this, that it is tied pretty deeply into the macroeconomy. The macroeconomy really gives these large owners of complex process facilities and portfolios of such facilities, it really drives pretty clear incentives around investing in reliability, sometimes in very targeted ways, sometimes in much broader ways. And so in my day job, my research is steered toward the macroeconomy to really understand, so I can, when I talk with customer facing folks, whether it's the executive level or all the way down to the plant level, we understand kind of from the structure of the economy, the way it's performing today, the way that these companies are generating their financial results and how they're getting rewarded by investors on the back end. I can help them understand this is what reliability really is worth in the context of today's macroeconomy. So that's the lens through which I'm viewing all this. That's how I end up, kind of pursuing the seemingly kind of random hodgepodge, collection of post topics I end up throwing up on LinkedIn. But to answer your question about the sort of state of the economy today, I think you characterized it really well in the question, which is there's a bit of a whiplash going on where, we came out of, over a decade window coming out of the financial crisis where rates couldn't get low enough and stay low enough long enough. I'm just trying to cajole investment into the economy and doing it with some incredibly extreme mechanisms that were all understandable at the time. And in a weird way, that's kind of the challenge is they were understandable and they lasted for so long that I think that there's a lot of inertia around, well, that's just the way the economy works, is we operate next to near zero interest rates. And we pull forward every available investment opportunity that we could conceive of into the future, pull it forward today, go pursue all of them simultaneously and see what happens. And then eventually we do have an inflation problem. And that really is the first time that we have to confront the reality of, okay, this is the challenge of working, near zero interest rates for such a long period of time. This is a clear manifestation of the cost that we've incurred for having done that for so long. And now it gets really challenging because we're sort of playing the other game, which is, interest rates are going up, and they've been going up now for a handful of months. They're going up very quickly. Don't know exactly where the end of those look like. We're getting a sense that pricing is starting to, pricing trends are starting to turn and become a bit more favorable, but pricing levels are still very high, and it makes it really imposes some affordability challenges across the economy. And then where I think about it, on the industrial side, it gets really interesting because there are investment opportunities today that simply aren't nearly as attractive as they would have been a year or 2 years ago. And it's
Right.
creating some really difficult challenges around how do we generate enough capital where we can, put ourselves in position to go invest in attractive ways. And then B, what is that portfolio of attractive investment opportunities look like out there? And both of those are, the windows around those are shrinking and have been now for a couple of years. And that's really challenging and really interesting.
It's crazy how big of an effect the risk-free rate can have on investment decisions and allocation. And when I was early in my career, I tried to do the CFA exam. I made it through the second test and ended up not doing it because it was miserable, and I didn't really need it. I just thought I would do it. But one thing I took away from that, and I have an MBA and I studied a lot of finance, but that exam in particular really focuses a lot on the math behind calculating all these returns. And what you see there is that the risk-free rate of return drives so much. And for so long in my professional career, it was just this really, really low rate. And now, as somebody who has different businesses, we do have, the ability to allocate capital into different things. And you start to look at it and you're like, man, if I can get 4.5% on cash, this is for a relatively low duration to get that kind of yield. Or even in a high yield savings account, if you have large deposits, you can get relatively 3% plus in some instances. And you start to think, okay, well, this is really changing my perspective on what investments look good, what investments look less attractive. And so it's driving a lot of different behaviors. It also changes like the valuations of these stocks, especially if like we're going to go into a recession and that's going to cause growth to slow down. And so that, basically this risk-free rate is going to ripple through a lot of different things. And so I guess where I'm leading with this question is we've seen inflation spike, and then now we've seen them rapidly increase rates. And I went back the other day and tried to look at like the last 100 years of interest rates and inflation. And I think like close to 50% of the time, maybe it was a little less, maybe it was like 45% or 40 to 50% of the time when we had these really big inflation events, in a fairly quickly time period afterwards, we were actually deflation. It was negative. So like in, the Great Depression, or like after the 2008 collapse, or the outlier there was like the 70s and the 80s where it was like really sticky and it was more structural. But I guess where I'm going with this is like, are we going to be in this whipsaw? Do you think we're going to be in this kind of whipsaw type of position? Because there's a lot of indicators right now, like the post you did on lumber and some of these other things, where it looks like we could be heading the other way fairly quickly. And if you couple that with the potential for a recession, it just seems like it's a really interesting forecasting environment.
I think you're exactly right. I think it's an incredibly astute characterization of where we are. I could absolutely see a near-term whipsaw effect where we just bounce around on these rates to try to get to a Goldilocks, meet in the middle type equilibrium. And I think it's going to be really challenging just because, and again, these words are sort of obvious words, but living it out and looking through these data sets, to me, it really helps me come to grips with how difficult the challenge of that dislocation starting in the early part of 2020 is and continues to be. when you introduce that big of a structural dislocation into any system, much less one on the size and scale of the global economy, these second and third order effects are astronomical, and they cascade far into the future. And so there's that bit where it's like I wouldn't be shocked to see us whipsaw here in the near term to try to get some kind of stability underneath us and lurch from one in one direction to the other, and struggle to really calm the waters a bit. But where I do think ultimately this coming decade, I don't think looks like the last decade. I don't think we go back to really low rates and just linger there indefinitely. Part of it is for the reason you suggested about when you go back and look at just historical trends around interest rates and just more broadly speaking, what the what the cost of money should or shouldn't be and what role that plays in the economy. It just doesn't make sense for that to live near zero indefinitely. There's also this whole element of the economy, right, for that 10-year window when you're living near zero rates. It was incredibly difficult on savers to really generate any yield, right? And so that's one advantage of having interest rates lift back up is there's this whole other side of the coin, the saving side of the coin that was getting incredibly short shrift before, and now we're normalizing a bit. So where there's real opportunities to generate a yield through saving. And just given the structure of a macro economy, I think it's a necessary place to be. But like you said, this whipsaw to get us back to a place where we get to quote unquote normal interest rates, it could be a nasty period here in the interim.
Yeah, definitely. And there's been a lot of deflationary forces the last 20, 15 years or so. You had technology, which is still rapidly moving forward, but things that were so disruptive, like the microprocessors and, everything, all the, computers and TVs and the internet and all this stuff that was just exploding over the last 20 years. That I think was a deflationary force. You had the shale revolution, tying it back to energy. That was, a deflationary force we had. And there was a lot of things that caused that, everything from like the land rush to get the leases, and then they had to drill them. And so it was oversupplied. And this was like a $1 trillion, benefit to the world economy in terms of how much, it reduced the cost of energy. You had like China and some of these emerging economies dumping a lot of, product to try to steal industry away. They were, people would say predatory pricing. They were doing a lot of that where it was causing the prices of things to fall. And then their labor in these countries was just extremely cheap. And some of those are kind of, the energy equation is getting more challenging, in the US, and we'll talk about that here in a little bit. The labor side, people don't want to make bare bones sweatshop labor forever. As economies and as these countries develop, these people, probably expect to make more. And then like the technology stuff, it's kind of baked in, right? I mean, yes, computer chips can continue to get smaller, and maybe we'll have quantum leaps here at some point around that technology, but we're kind of seeing the end of that era a little bit and into this new normal where it feels like real things matter again. You could have these crazy growth multiples on these tech stocks. And if you look at like, the Nifty 50 back in the day, and then how those really underperformed and they thought those were the blue chips. It's like some of these tech blue chips, it's like, can they continue on that trajectory? Or if we're in these higher rate environments for longer, is this just like a paradigm shift? Like you said, is the next decade going to really be different? But what do you think, like some of the changes in this new normal that we'll see kind of in the markets and in the economy? I know it's a broad question, but we're kind of up in the clouds right now. We're just sort of riffing in that realm, and then we'll get more specific.
That's right. No, it's this is a fun one to think about, and I don't have incredibly structured thoughts on this one, but it is something I toss around quite a bit. I think that you're exactly right about this wave of deflation that crashed over the course of the last decade, and particularly on the energy side. I mean, I think that's in a way that one's obvious, but I think in a way it's still underappreciated how much that mattered to have such abundant access to cheap energy over such a long period of time. And then not only was the energy itself abundant, but like you said, I mean, it was subsidized through investor capital that create a lot of sort of knock-on advantages outside of those investor groups, and that stuff increasingly goes away, we're moving to more of this manufacturing model, and in terms of how energy is produced and supplied and distributed worldwide. There's all the ESG concerns that mean we don't have the investment in traditional hydrocarbon sources aren't nearly sort of as attractive or as welcomed as they historically had been, and so that introduces some real cost friction that the economy has to deal with. I think when I think about the deflation angle that you had brought up, it's one again that's hitting us in the face all the time, and I really don't buy into it all that much, but it's because it's so visible and it's so widely discussed. It is something I end up thinking a bit about, which is increasing automation, right? If you could automate away some meaningful fraction of global labor markets, that would be one way to drive costs way down. And you see it with the Chat GPT.
I was going to bring that. Yeah, that's what I was going to say. Yeah.
Yep. You see that's coming up. You see, well, like you were saying with the you see on the hardware side, the chips can keep getting smaller and faster, and memory can perform better and all the rest. And all of that is in service of, can we create better sources of intelligence or acumen or capability to offload some amount of labor onto and free us up. And I think maybe that this gets really philosophical, but I can believe all of that would happen, and yet I think the history of humanity suggests we find ways to keep people employed and engaged, and there's always work to be done. That work transforms. There's sort of tedious manual work today that is done less by human beings than it's been done in the past. There's a lot of automations around manufacturing that didn't exist even 20 years ago, much less 50 years ago. And so, those endeavors look a lot more automated and do, sort of on a per unit output basis, require less human labor intensity than has existed in the past. And yet, there's always new problems to solve. And so, for instance, that ChatGPT stuff, and I forgot who had said this, but someone had come up with a hypothesis that, like, look, this ChatGPT stuff can be really interesting in the sense of this may be a first draft that then a human creator goes back and edits and modifies and supplements and pivots. And so it takes sort of the effort away from getting stuff down on paper, but it's not that the computer has come up with necessarily the right answer in all of these situations. Yeah. So that's one example, right, where human labor can still be incredibly important. And I just think it's just as human beings, we're just wired. I think because we're social creatures and we're very community driven. And I think that there's this deep-seated sense of fulfillment that we get out of making a contribution. And so I expect that sense of being compelled to pursue making a contribution to continue to exist regardless of the state of automation technology. With all that said, I'm curious, because just the way you posed the question, it made me think that you've probably noodled on the deflation angle a bit longer than I have. Where is your, like, if you had to kind of plant a flag and where you expect those kinds of dynamics to evolve from here, where do you think they go?
It's hard to say. I do think that, I had a guest on and someone had made a tweet that said, like, it was in regards to Taiwan, and they were saying that it's kind of like the Arrakis from the book Dune, which is I don't know if you've read it or seen the movie, but like they control this substance called spice, which is like the most valued substance in the universe because you can use it to travel through space or whatever. And that's like the main thing that everyone's focused on. And they compared the chips and the semiconductors like that to the spice in the movie, and that was the main thing. And I kind of made that point, and some guy was like, no, man. He's like, it's oil and gas. He's like, people were convinced that was the thing for the last 10 years. But what we're realizing this year and last year specifically is that you still need real stuff. You still need, the physical world still exists. Like, as much as, Mark Zuckerberg wants us to be in the metaverse, and I'm not saying that we won't be someday, but at some level, we still have to eat. We still have to have energy. We still have to do these things. And so it does seem like we're shifting to a priority on things that are real, tangible things, commodities, et cetera. And this was something that was very prior to this shift, like call it 2020, when all the tech stuff was going crazy. I really struggled with it. I struggled with like understanding it, like wrapping my head around how we could. I mean, it felt very unsettling to see the stock market doing what it was doing, knowing that everybody was sitting at their home not working. I was just like, this is not. It feels very eerie what's happening right now. And looking at the valuations of these companies, Tesla being, I like to pick on Tesla a lot. Not that I don't think that there will be some meaningful adoption of EVs, but Tesla in and of itself and the valuation that it had being worth more than, ExxonMobil or like all the other car companies combined and all these things. I'm like, this just doesn't feel right. And there was something intuitively off. So I feel like part of that had to do with, this cost of capital thing. I mean, when it comes down to it, it should matter. Whenever the mechanism for pricing risk is broken, everything is kind of broken. Like you really don't have a way to correctly measure the world, or at least the financial world. And that ripples through investments. It ripples through, commodities, all these things. So if the cost of capital stays elevated, then I think that we're going to see more of a focus on real stuff that matters, earnings, cash flow, producing things, because I think that will matter. And then in terms of like where the tech stuff is going, it just seems like obviously it's hard to bet on technology long term, but in the short term, it's like they have to be real businesses that provide, real services that people are going to use. And I just think that like as we shift into this new future, I do think that energy is going to play a big role. Commodities are going to play a big role. It's like who's actually making the real stuff. The ESG angle is something I've noodled on a lot, and it's another perplexing thing to me. I tried to be very open-minded going into the podcast because I have a background in oil and natural gas, and I didn't want to just be this like, I hate renewables thing, because, that's easy to rile up the base, right? If you want to get engagement, you can talk crap about how windmills kill birds, and people are like, yeah, and they give you a bunch of likes. So I want to be open-minded. So I've talked to a bunch of different people, and what I've scratched my head about on the future of energy is like, we have like effectively, for all intents and effectively limitless carbon-free energy in the form of nuclear. That industry is not healthy. It's kind of dying. We're getting this other industry of renewables and batteries and storage, and we'll talk about this here in a minute, getting forced onto the marketplace by a lot of capital allocators. So that to me is probably going to be inflationary. I think that as these central planners continue to get in and, they want to do healthcare, they want to do energy, they want to do all these different things. I think that what we've seen is that the less the free market is involved, the more dislocations there are in that marketplace. So in summary, I kind of rambled there, but I think that a higher cost of capital is a good thing, I think. And I do invest in real estate, so I'm not going to say I hate it when interest rates go low, but I think there is a healthy interest rate, risk-free rate that needs to be there, and it's definitely not zero. And so that, I think, over time will help some of the misallocation of capital. And then the other thing is, like on the energy side, we're going to have to figure out if we really want to go to a low-carbon economy, what that looks like. And we need to be more practical and realistic around those solutions like natural gas or nuclear, in more of a mix than just hey, we got to get rid of all this old stuff and put the new stuff in. So that's kind of a rambling thought of where I think things are going. I think the energy crisis and everything that's happened this year has changed a lot of perspective. I think some of these capital allocators are coming back around to the idea that we need to continue to have oil and gas. So I just think yeah, go ahead.
Well, yeah, sorry for interrupting, but I think you're spot on. Where you started this, I think it's incredibly important. And again, it's one of these deals where it's like, duh, it's obvious. Real stuff matters, I think is the quote you used. And that is kind of bizarrely, profound, right? That it's a message that I share inside of Pinnacle a bit, because again, those are the customers we have are, petroleum refiners, petrochemical plants, the mining operations. We do some water and wastewater stuff. And that gets really interesting. I tell folks internally, that's one of the reasons I like what we do as a group so much is, these are real things. These are real, commodities, real inputs and outputs to people's lives, and they depend on it. And when your clean water doesn't come out of the tap, or when your dirty water does not, go down the toilet or down the sink, right, there's enormous problems. And I have been surprised, particularly now that investor reliability is my day job. I've been surprised of what a vanishingly small fraction of the aggregate human intellect is steered toward real stuff. The food that we eat and the water that we drink, the shelters that we have, the energy that we use, in a fundamental sense, right? Because like you said, there's an enormous amount of attention paid to energy in a more kind of political tit for tat type argument, which, like you said, riles people up and is good for engagement and all the rest, but doesn't really help us solve problems and overcome obstacles and build this future that we're trying to build for ourselves. And so it's interesting to me that, even when Zuckerberg was talking about the metaverse, I remember reading what he had written, and he does mention the fact that, yes, the real world will always matter. And in a weird way, I felt almost even worse after having read it, that like it would, I think I would have felt less bad about it if he just hadn't even mentioned the real world. It was just like, hey, we're doing this metaverse stuff, we're sinking all these billions of dollars into it, it's going to be awesome for all these reasons, and this is what matters, this is why we're doing it, great, like go knock yourself out. And I'm not trying to be throw shade at that. Like that, the guy has billions of dollars, they can do with their capital what they want to do with their capital. So if those are the bets you want to place, I do celebrate how bold a bet that is. And so by all means, like if that's you, then do it. At the same time, these real things absolutely matter. And if we don't steer enough intellect and energy and effort against those, we will absolutely run into real problems. And so it's not a message that I ever would have thought that I would have had to share, or that those words would be at all valuable coming out of my mouth. But I think you're spot on. Real stuff matters. And I'm always surprised by how not as widely recognized that is as I would have expected.
Yeah, like you can have, like when you get to the top of Maslow's pyramid and you're standing kind of tippy-toed on there, which the Western and developed world is, or, for the most part, energy or Europe is facing some pretty real issues down at the bottom of the pyramid with just like basic needs for people, which is scary and sad. But when you're at the top and you have all those basic needs met, then yeah, the metaverse sounds great. We're already all kind of in it anyways. We're just on our phone. I think what they're trying to do is make more of a wearables, more of an AR, augmented reality. And I think if the goggles weren't really big and bulky, and if it was just a pair of glasses that you wore and you had all that stuff, I think it could actually be a real thing in the future where you're just more integrated with all of it rather than looking at your phone. You're kind of like immersed in it as you go through your normal everyday actions, which again, we're kind of already doing that. We're just staring down at a phone. And so ultimately he's kind of trying to make it more like, you see it and all these things, and that technology will probably get better over time. But to focus on that stuff, to get to those higher goals like decarbonization or, virtual reality or living in this thing, you have to have those basic needs met. And it's amazing. You made the point earlier of like a decade of just kind of really, really cheap energy, and you just kind of take it for granted. And so unless we can get back to a place where it is a foregone conclusion that we'll have really cheap food and really cheap energy, and that stuff will just be met, and the climate's not going to get ravaged because we have a way to make ourselves cleaner over time. If we can get to that place, then yes, I think then we can live in that metaverse. But until that point, and right where we are today, I see a massive lack of I see misallocation of capital, and I see a lack of investment into some of these basic things. And part of it is like the deglobalization stuff that's going on with the war in Europe. And there's a lot of factors. It's a complicated thing, and we could riff on this forever, but I want to take it back to energy, and we'll talk to a little bit domestically. Just your thoughts on the, domestic oil and gas industry. I know you worked at Baker Hughes. Is that right? For a long time. Or was it Schlumberger? Which one was it?
It was the Baker Hughes.
Baker Hughes, right. So you worked at Baker Hughes for a while. You obviously understand the energy, or the domestic energy industry, and probably international as well. But just your general thoughts on the U.S. oil and gas industry, and then we'll talk about power markets and things like that, and some of the other stuff here in a little bit.
Absolutely. So yes, I was at Baker Hughes for 8 years, and then I went to Key Energy Services in the workover space for about a year and a half, and then I joined Pinnacle. And so Pinnacle's my exposure kind of to the downstream side of the equation. Right. And what gets interesting to me, so again, I try hard. If I have a fault, right? I think anyone that has any interest around, financial performance, macroeconomics, and all the rest, none of us are perfectly calibrated. And so for me, it's a question of, okay, am I going to err on the side of going too deep in the weeds, or of living too high? And when I err on the side of being kind of flying too high, because I really want to make sure I do not miss the perspective of history. So for instance, one of the things you said already in the conversation that mattered a lot to me, it really triggers me to want to go back and do a deeper dive into this than I have, is the 100-year of interest rate history. Say any sort of long historical time frames, I'm a sucker for, because I think it just informs, it gives us so much more context in terms of where we are today, how we got here, and what the future may look like. And so I think what happens is, when we talk about U.S. oil and gas, or U.S. energy more broadly, though that 10, 12-year window coming out of the financial crisis, I think just looks so different than what these next 12 years look like, that it makes it really difficult for folks to kind of gracefully pivot into this new landscape we're in, and B, sort of gets the whole population addicted to this idea. Well, of course we have cheap, abundant energy sources available at our disposal. That's how we can have these high flying arguments about whether we should just turn oil and gas off entirely and all that. There's just those kinds of conversations aren't grounded in reality. You can have those kinds of conversations when energy is so abundant and so inexpensively available that we don't have any notion of opportunity cost or how to deploy those sources or how to bring on new sources. It all just seems so easy that we can just talk philosophically about, wouldn't it be great if we had some other energy mix that didn't impose these kinds of burdens that our current mix does. Well, now we're learning that these energy supplies that we have aren't infinite. While the actual supply of oil and gas under the ground is enormous, what really matters is the economics of it. How expensive is it to extract the stuff and get to the surface and use it? And that cost can change rapidly, right? Depending on what's happening with the regulatory environment. What you said before about capital allocators, like if there's a large enough group of capital allocators whose tastes change in a meaningful way over a relatively short period of time, that can have incredibly consequential impacts on the cost of producing and consuming hydrocarbon-based resources. And so what you mentioned about Europe, I mean, there's heartbreaking stories of what happens when populations no longer have access to the supply of energy that they're used to having access to. Even incredibly affluent societies that have all the resources that you would conceivably want to have to try to fight some of these challenges. If you're not prepared for the challenge, right? If mentally we just haven't been embracing this idea that that those past 12 years was a pretty non-representative era of history, and so now we're not going to have shale investors that are just plowing billions upon billions of capital into companies that aren't generating any kind of return. And we have a more hostile regulatory infrastructure and a more hostile public relations environment around hydrocarbons. And so I'm not making any normative statements about whether any of those things are good or bad. It's the conversation now has to pivot to, we can, of course, ramp up the hostility around oil and gas. We can ramp up the urgency of getting to low carbon or carbon free energy sources. And any choice we make there does come with costs, right? So it's not this case where we just very cleanly and painlessly shift from one energy source to another and we're on our way and all is good. It's like, no, this transition can be incredibly painful if we don't manage it the right way. And so when I look over the next 10, 12 years for U.S. oil and gas, it's an interesting spot to be in, because I can see these commodity prices being higher than they were for those, for most of the past, certainly coming out of 2014 as prices crash and oil prices live in this $40 to $60 regime for years and years. I can see commodity prices being meaningfully higher than that, and yet oil and gas management teams still feeling constrained. Like, how do you deploy this capital? The easiest thing in the world is just turn around and give it to shareholders. They're not going to be too upset at you over that, but that doesn't grow in energy supply, and that doesn't help us figure out, if the U.S. needs to be in position, if we're the ones that can generate an abundance of safe, stable natural gas supplies that the world needs to keep the lights on and to keep homes heated in the winter, then this country would need to embrace a very different attitude and approach and framework around energy than we have right now. And I think all those conversations are incredibly valuable to have. And it's what you mentioned when you, in the lead into this, when you were talking about how easy it is for this stuff to become clickbait and political hot potato. Like, it's this conversation can be kind of contorted in a way where it's not a productive conversation. And as I've been doing more of my own research and sharing a little bit more of it publicly, I'm trying really, really hard to lean into being one small voice in the conversation, like you were saying before, that's trying to pursue this kind of data-driven, idea-based, communicated in a very sane, kind of de-escalatory way. Not trying to inflame sentiments one way or the other, because folks really are sensitive around all this. But it's such a difficult problem to solve that we're not going to solve it by either not engaging or by only engaging by taking shots back and forth across. So I think that's where, when I think about oil and gas going forward, that's where I think of it's a more deeply constrained environment than we're used to. And I think it's even going to be difficult to have productive conversations about what we change in order to make that space succeed in a way that we need it to succeed going forward.
I agree. What you said about returning capital to shareholders is really interesting. If you look at where people are at today, inventory is getting more scarce. There's like the valuation. So there's like all these unintended consequences from the capital allocators and what they've done around the ESG stuff, and kind of like, and BlackRock's pivoted and some other people have pivoted. But for the most part, a lot of the endowments, especially college endowments, some of these pension plans, a lot of these groups are very committed to either divesting or not investing or underinvesting in public equities for oil and gas, as well as private equity into management teams and companies that are boots on the ground drilling for the wells. And so it has a lot of ripple effects that I don't think actually help the transition to a lower carbon economy at all. I mean, one thing is, look, if your stock price is depressed, and they are in the oil and gas space based on historical valuations, especially versus where their cash is at and where their debt is at, and you say, okay, well, I could go out and I could ramp up a bigger drilling program than I have, but my stock price isn't going to reflect that value because none of these major capital allocators are, buying the stock. So I'll just buy back shares because my stock price will go up then. And all the management teams are incentivized to, they're compensated through stock. So it's like they want the stock price to go up. It used to be you had to grow production. And when they were incentivized to grow production, they grew production and they were graded on that. And now that they're not being incentivized to grow production, they're being disincentivized to grow production, then they're going to do that. And that's going to cause the price of energy to go up, which then ripples through to all these other industries. Like you said, you work with chemicals and, manufacturing, all these other things. And it makes the price to transition higher because, renewables and wind and solar are heavy industry. I mean, the carbon's loaded up front, but there's still lots of carbon, and in the theory is you use them over time and they offset and then they use less carbon. But people forget you still need a lot of carbon. You just have to do it in time zero, right? You do it up front. And I don't think it's going to make the transition easier. And so there's a lot of unintended consequences there. The second part of what you said, I think, around the conversation, I mean, nuance is the enemy, especially on social media. And like, I'm guilty of it as well. It's like I've grown a following on Twitter, and like, I sit here and post a really thoughtful thing about natural gas prices or storage or something like that, and 10 likes, or I make a funny meme about solar or wind or something, and poke fun at renewables, and it gets 1,000 likes. And so you're like, okay, well, I see what people are engaging with. But it's both sides too. Like the renewables side, there's a lot of kind of just don't pay attention to all the negatives and challenges that we're going to have. Like, these are going to solve all the problems. And it's like, well, actually, there's a lot of steps between here and where people want to go. So I think having the conversations that we're having, I've said this a lot on the podcast, I think it's important, but it's also important for people to get into the details, get into the nuance, because on both sides, people are guilty of just kind of like, making it seem like, oh, this is bad, this is good, when reality is it's all kind of gray and in the middle. And anyways, one of the next question I want to lead there is it's a real tragedy to me that we've seen such a sentiment change in young people around getting into the oil field or getting into hydrocarbons or whatever it may be, refining or the downstream stuff as well. And there's just like a very negative sentiment around the industry. And then also like at the field level, I mean, these are really critical jobs that we absolutely need. And like I made a tweet yesterday that was like, oil and gas is going to save millions of lives this week because of the temperatures that we're going to get down to, yet it's vilified. And you had a post around oil field worker scarcity. And so it's like, not only are these young people being told that this industry is bad, it's dying, it's going away, it's also really hard work. So they get in, if you don't have someone that's passionate that wants to be there, like, we need these people, they're critical. And yet it feels like there is, I think we were like the lowest ever for petroleum or in a long time. I can't remember what the stat was for petroleum engineering graduates. I know the oil field is really short, but just talk some about how the sentiment and how these things are affecting workers and some of these, like in the oil field side of it, the ability to get quality workers and how that's rippling through and affecting the industry.
Yes, this is one that I do feel pretty passionately about. And before I launch into this, there was one bit of their the commentary that you were just giving that I think it resonates strongly with me. And again, it's sort of a nuanced element of this, but it is something that I could talk about all day. I won't talk about it all day right now, but this notion of public markets and how energy companies, couple into public markets and what the value of that looks like. And if you have investors turn away from oil and gas companies and public markets, eventually those valuations get sufficiently depressed that those companies are just taken off of public markets and held privately, where returns can be much more attractive. And I think that frankly is a net negative for the world. I think you want these hydrocarbon assets that have an environmental footprint associated with them, right? So there's a very real effort that we need to make sure that when we're generating energy from hydrocarbon sources, that we're doing it in the cleanest, most reliable, safest way possible. Having the scrutiny and the visibility available through public markets is incredibly valuable to the world. I believe that value is under-recognized, and it's something that as soon as you take some of those assets and park them in a private portfolio, we then no longer get visibility into what's happening and how and why and how it's evolving over time and how that might then inform any sort of regulatory pivots or other political pivots that we want to make, broader public policy pivots. And so that is one of my concerns when I see investors pivoting away from that space on the whole. Is again, and I'm super sensitive to it because the market research that I do relies so much on publicly available data sets that having that kind of scrutiny and visibility available creates a lot of value. And so that's one way in which I'm concerned about having dysfunctional public markets as they connect into oil and gas can really create some trouble for all of us. So with that part to the side, yes, this notion of sentiment around oil and gas, I think, is incredibly troublesome. It no sort of rational, right-minded person is imagining we are going to build this energy mix for ourselves that is 100% carbon free at any point in time anywhere close to this lifetime. There's a transition, and it's a transition that will occur over decades and decades to get to a point where the carbon intensity of the energy sector diminishes with time. And so oil and gas is going to play an incredibly important role in our energy mix, again, for at least decades into the future. There is real value in having dispatchable energy sources, of having liquid fuels that you can easily transport from one place to the other, that don't require any sort of cooperation from the weather and don't require some step change improvement in energy storage technologies, like the energy is already stored in a stable form as it comes out of the ground that we can then transport more or less easily. That's incredibly important. And so while that fraction of our energy mix will shrink over time eventually, it will be an incredibly important fraction that we do need to manage with care and with grace and with ingenuity. And so folks that want to make their professional contribution in that space, it breaks my heart to think that they feel shame in any way for having done that. It's a message I try hard to carry inside of Pinnacle. Our employee community inside of Pinnacle skews toward the earlier career aspect, and so I am sensitive to this idea. We're getting early career folks that what they hear is the PR landscape that exists across energy today. They weren't aware of what it was like even 10 years ago, much less 20, 30, 40 years ago. And I try to tell them that the importance of the contribution that we're making. That like you said, I mean, literally saving lives. And oil and gas. When you operate these assets reliably and cleanly and safely, we are extending the runway on which humanity can pursue these more exotic energy innovations that will be necessary for humanity to thrive on Earth 100 years, 1,000 years into the future. So you can't just flip an oil and gas switch off. And so I think it's important that we acknowledge the value of doing all that work and doing it in the right way. And I guess another reason I get a little worked up about this is, while I've never had a field job, and I always make very clear, I don't want to pretend as though I've had an oil and gas field job. I haven't. I have worked very closely with folks who do, have had or do currently have oil and gas field jobs. And like you were saying, those are incredibly difficult jobs to have. They're on their face dangerous, which is why we put so much care and effort into safety practices and procedures. And why I think safety, improved safety outcomes should be even more widely celebrated than they are, because the work itself is just so incredibly dangerous. For us to do it in aggregate as safely as we do is a remarkable achievement. just the physical effort that goes into doing some of that work, particularly this time of year, up in the northern U.S. where the temperatures are just, unbearably cold, and these rigs don't shut down. These folks aren't getting off of those rigs. I mean, we need the energy, and if we don't need it, other people around the world need it, so they continue to produce it. Like I said, I worked a little bit on the workover side. Those folks are out there every day, in the middle of summer, and who knows where, West Texas, where you're just baking, and these folks are out there doing really hard work. And so, like I said, I've never had those jobs. I've always made sure when I interact with folks that have those jobs that I try to genuinely express to them my appreciation without going over the top, not looking like I'm trying to, compensate for the fact that I haven't done that work. But it's just that work is incredibly important to have done. And I do feel shame, frustration that those jobs aren't as widely celebrated as they should be. So I don't have a great answer in terms of how we change that. And so what I try to do, very frankly, that's one of the reasons I publish on LinkedIn the way I do. It's one of the reasons I was so excited for you to invite me to have this conversation the way I have is I think it's just, one-to-one human scale communication, that the more we can have these conversations and have them in public and have them out loud, because there's a lot of folks, right, that are deeply bought in around, an aggressive energy transition and around championing renewable energy technologies that are not at all malicious or vindictive or trying to play a political game around it. Right? They just have this deep-seated belief that this must be the right way forward. And I think sharing more of the realities of what oil and gas as an industry looks like and the sacrifice that goes into generating those energy sources and having it be where every time we hit a light switch, lights come on and all the rest. I think that there's real value in having those kinds of conversations. So it's something I lean into. I'm sorry for running long on this one, but this is one that I do feel a lot of passion about. And I do try to engage, even outside of podcasts or whatever, when I'm just around the office one-on-one. It's a conversation I think is incredibly important to have.
It is, and I think that this the education stuff and talking about it and given young people tend to gravitate more towards some of these forms of media versus older generations with the legacy media. So I do think that these conversations reach people, and I've heard from people that are young and looking for career paths that this kind of stuff matters to them. So I think I'm glad that you did go on that stretch there and talk about it because it's important. But moving, you mentioned like flipping on a light switch and everybody kind of taking that for granted. One point that we had on the list of things to talk about was kind of the electricity markets this year. Prices are booming, I think, as you put it in one of your pieces. Talk a little bit about what's happening in those markets, kind of what's some of the cause and effect there. We know, obviously, the base input on hydrocarbons is up, but there's also a lot of disruption on the grid with new intermittent sources as well. So just kind of pivot into that portion of the conversation. Get your thoughts on it.
Yes, it's so like you said, there's the sort of the first order, the immediate root cause for booming energy prices. It's easy to see, oil and gas prices are up, coming out of the pandemic, and up aggressively, and that's all true. That's correct. And yet, like I said, I sort of err on the side of zooming out. We have this electricity grid that's transforming incredibly rapidly relative to where it had been for such a long period of time. And we do have these new intermittent sources, predominantly wind, but there's solar that's becoming that's growing pretty quickly as well. And both those sources. So I am excited about those kinds of sources in general, right? So I want to make that clear. I'm not out here rooting against those kinds of sources. I think we have there's an energy mix, an optimal energy mix that does feature more of a wind and solar contribution than what we have today. And yet, so this is the important bit. The intermittency that you then see when you introduce energy sources that are dependent on cooperation from weather patterns means that you have other difficult problems you have to go then solve. And one of them has to do with energy storage. How do you find a way to retain access to energy that you can dispatch at a moment's notice when weather doesn't cooperate the way you need it to going forward? Hydrocarbon sources are an incredibly easily dispatchable form of energy. They're easy to store, they're easy to fire up and use, and that's the way our energy grid has worked for a long time now. As we get more wind and solar energy sources coming online and generating a larger fraction of our electricity mix, it means that we have more and more natural gas sources that are firing up and down sporadically as we need them. And that creates cost, that creates friction, that creates a lack of efficiency than if you were just able to run a lot of these sources continuously, you could drive unit costs back down. But we don't have that luxury as we harvest more and more of our energy from wind and solar. So that creates an added cost burden and added technical challenges that we have to resolve in order to gracefully pivot toward having this electricity generation and grid infrastructure that operates as reliably as we need it to operate. And the last thing I'll say on this one is what you mentioned early on. And I feel like this is the one where I feel like closest to I must just be insane, which is with the nuclear side of the equation. That it's like in a canonical sense, it's a baseload source. It is the traditional way that you would fire up a nuclear plant and just let it run. There's nothing intermittent about it, ideally. And yes, the capital costs are incredibly intense to get these things built. I think there are ways to mitigate that. I think folks are working on it today. I think there are new technology innovations around smaller reactor technologies and all the rest that will make nuclear more palatable economically. But I think there's also some regulatory changes that we can make to make it easier to build and deploy and harvest energy from nuclear sources. And the way the world collectively seems to have just lost interest, in like Germany just actively turning away from nuclear, just boggles my mind, because it seems to be something that resolves so many problems that we face today. It's not a perfect energy source, nothing is, but the problems it introduces versus the problems it solves, it seems like, man, we would want to lever more of our energy infrastructure against nuclear. Obviously, we can't have 100% nuclear energy infrastructure, but to lever it more than what we have today sure seems like an obvious solution to me. And so, long story short, we have oil and gas costs prices that have been going up, driving energy costs up. We have these this increasing intermittency from more wide adoption of wind and solar that drives some added costs on the back end so that we can gracefully deal with that intermittency. And then just the opportunity costs that we're incurring from not having taken nuclear more seriously means that we're struggling in the ways that we're struggling today.
Definitely. Well, the nuclear thing is one that, I mean, everything you said is I agree with there, but the nuclear one is one that's been really I focused a lot of my time and thoughts on. And it's not that I'm against these other energy sources, particularly solar and wind. I just feel like they create problems too. And the problems that they're creating, a lot of the solutions to those problems we don't have yet. And we're just kind of rushing headlong into it. And there's a lot of hype around batteries and some other things that's just not there. I mean, we're just not ready for it. Yet we have solutions today that are ready for prime time. I mean, natural gas is ready for prime time. I mean, if we could convert, EQT does a great slide, and they talk about how if we could convert, all the international coal facilities in places like China and some of these other places where they're burning a lot of coal, it would be the equivalent of, they have some slide where they show if we could install this much of export capacity and that could be, soak up coal demand, that it would be the equivalent of electrifying every car in the US, and it would be the equivalent of putting rooftop solar on every home, and the equivalent of putting like 56,000 windmills or something. They have this incredible slide that just shows if we could replace this many of the coal facilities in the world with U.S. natural gas, that we could effectively do what may never happen in terms of some of these other energy transition goals, and we could do it rapidly. I mean, I think they had like a 5 to 10 year time frame, and then you look at like what nuclear could do. You look at the potential of like carbon capture, which is being now pushed back against by there was like one of these major carbon pipelines that now Sierra Club and others are coming out to say we don't want this, and it's like this is just going to reduce a ton of emissions, and they don't want it. So I think for me, it's like there's a lot of politics involved, whether you want them to be or not. When I went into this, I was like, oh, I don't want to do politics. It's like, well, sorry, it's energy. Like there's just so many, fingers in the pie here. And there are solutions like nuclear that if we took the Inflation Reduction Act, and I've said this before, and I had a nuclear guest on, and you use that capital, the $400 billion or 350 or whatever it was, as seed financing for new reactors, we could have built like $1 trillion worth of reactors. And it would have been like 20% or something, and we would have decarbonized in a massive way. So it's not that like I'm against the other energy sources. It's just that sometimes I feel like there's a push to these things that's not grounded in reality around what we can do and in the pace we can do it in, right? Like the feasibility of it. I mean, I think it's easy to get to 20%, 30%, maybe 40% kind of renewables on the grid. Like you've seen some areas like Oklahoma, we have a lot of wind. It's also really well situated for that. Like it's a really good environment for wind, and you can get to these hurdles, but then to get to that 100%, which is where people want to go, there become a lot of challenges. But one thing you mentioned in your notes was like around capacity factors and some of these things. And you was specifically a note around nat gas, combined cycle turbines versus wind. And I just skimmed through that note because I was putting together an outline for this, but just your thoughts on the comparing those two, maybe talk to people about what capacity factors are, why that's important. And then maybe also mention, I think you'd mentioned something around how some of these hydrocarbon-based baseload fuels are getting, disadvantaged because of the fact that they're having to compete with the intermittency or whatever. But anyways, just talk on that, because I thought that was a really interesting note that you put out.
That's right. Well, thank you very much. So yeah, the capacity factor is just a ratio. You can think of it as utilization. It's how much electricity does some plant actually produce relative to what the plant could produce if it was running full bore continuously. And something where you see for the U.S. nuclear portfolio, I think you see an average capacity factor somewhere around 90%, 92%, 93%, something like that. And the vast majority of individual nuclear plants are well in excess of 80% capacity factor. So these are very highly utilized plants, which is exactly what you'd expect from a nuclear facility. No one's ever really talked about trying to ramp nuclear facilities up and down depending on instantaneous energy demand. Like you turn them on, you get them going, and they go, and they just generate a ton of electricity. And so you can do this for all the different sources of energy. And so what gets interesting on the renewable energy side is the capacity factors get pretty low because, again, the weather has to cooperate with you in order to generate electricity. The wind has to be blowing, the sun has to be shining. And so it can drive capacity factors down to the 20, 15, 20, 25, 30% type range. And so as a result, and if you're going to prioritize, those plants, if you're going to say, hey, anytime a wind plant or a solar plant is generating electricity, we're going to take it. We're going to use it. We're going to buy it. We're going to do something with it. Great. And there becomes a challenge on the back end, which is as soon as the wind, stops blowing as hard or stops blowing entirely, or as soon as the fog rolls in, we need something else that we can kick on to generate the electricity that we otherwise would have gotten out of those renewable sources. And so that means what gets really interesting. The reason I wrote that post was I was really interested to see our natural gas fleet of plants does not operate with the capacity factor as high as I would have expected. That right. Basically you have a tails of distributions. There are definitely natural gas plants that are on and running full time. I was surprised to see how many of the natural gas plants don't do that. And I believe it's primarily they need to be positioned to be able to generate energy when wind and solar plants can't. And so what it is when you look at these capacity factor plots, and when I'm talking about a distribution, what I had created, the visualization I created was I bucketed capacity factor in groups of 10%, from 1 to 10%, 11 to 20%, and so on. So the x-axis just had these 10 buckets. And I just put, okay, the total fraction of all the plants that we're talking about that operate in this capacity factor range, I'll plot that there. And the next bar will be the plants that operate the next higher capacity factor, and so on. So you see this very skewed distribution in nuclear, where so many of the plants are operating 80 to 90 and 91 to 100% capacity factor. You also see a very skewed distribution for wind and solar. They're on the very low end. There's a lot of plants that are operating 10 to 20, 20 to 30% capacity factors for both of those. Natural gas, I guess the visualization that is fairly characterizes the notion of natural gas being a bridge fuel. The natural gas is kind of a bridge distribution between these two. There's some natural gas facilities that are operating with very low capacity factors. There's some natural gas facilities that are operating with much higher capacity factors, because we're asking natural gas to be this bridge fuel between the two. And so it's an analysis I like to do, because as you peel this onion back, you realize, man, there's just so many moving parts when it comes to electricity generation here in the U.S. And like we were talking about, you introduce new challenges for yourself when you start pivoting toward or away from different technologies. The last thing I want to mention there, and you're exactly right about the politics, like it's unavoidable when you get into energy. And in this case, with the renewables, I think even if you strip the politics out, what gets really interesting, one of the comments you made, that I'm glad you made it, because my mind wouldn't have gone there without you having made it, which is, in order for sort of renewable energies to work, across a complete life cycle, you need the generation, but you also need really good energy storage, and you need, of course, the transmission distribution element. Well, because we're still such early days in the viability of renewable energy, there's these generation technologies that absolutely work. We have wind turbines that absolutely generate electricity. We have solar panels that absolutely generate electricity. And there's an enormous amount of work into going into making those even more efficient. And I remember when I was an undergrad in engineering, I took a solar photovoltaic class. And I remember learning about the history of photovoltaics, back into the 60s and 70s and the work that had been done. And it's truly a fascinating place for people to go make a technical contribution. So that's exciting and interesting. And yet, like you were saying, the energy storage bit lags substantially behind the energy generation bit when it comes to renewable energies. Well, the challenge is, even when you take the politics out, I mean, human beings are wired in a way where there's a lot of first order thinking that, hey, we have these technologies that can generate electricity from the weather. We know they work. Let's go deploy them. Let's go incentivize people to make more of them and deploy more of them and all that. And to first order, it makes sense. I mean, you're trying to make the energy infrastructure even less carbon intensive, and sort of a natural way to do it. The challenge is when the innovation around energy storage hasn't caught up, then we are really in a lurch here, because we have to start using natural gas facilities as a bridge to help deal with this intermittency. And it's just very costly. Both just to turn the things on and off, but again, being in industrial reliability space, it introduces real reliability concerns. You're introducing much more stress on equipment, and so it's just more costly across the board. And so I'm with you about if I had a magic wand to wave around, okay, if we're going to invest public dollars in executing a more effective energy transition, I think nuclear is an absolutely viable target to go steer some of those dollars toward. It would be very interesting, I think, to go take some moonshots around energy storage, because it doesn't feel like we're all that close to having a compelling energy storage solution. And yet I am such a big fan of human ingenuity that there has got to be an answer. Like, if we throw enough really clever people in the right environments against that problem, we will come up with solutions. And yet we need to go make those investments to make that happen. And we need to make sure not to get too far over our skis by incentivizing the deployment of energy generation technologies that we do have today without the energy storage stuff to back them up.
Definitely. That's good. And we could go more on that, but we're getting long here on this. And I guess I'll conclude on that, on some of the energy stuff there, is that I love certain applications for solar. Obviously batteries, I mean, phones, there's different things that, they're just incredible that you have batteries and that they do what they do. I love solar powered watches. I think they're amazing. I've got an RV that's solar powered. It's awesome what it can do. And I think I love the idea of rooftop solar. And so there's a lot of things that these technologies can do that are amazing. And I don't want to downplay that, but also just try to be realistic around the limitations and the path forward and meeting the goals that people set forth. Because it's like, these are some pretty ambitious goals. And, we have tech today that can, that I think could get us there, but it's got to have the right conversation, and people have to have the right framework around it. I don't know how much time you have left, but you did put some interesting things in here that are more on the just kind of miscellaneous. Do you have a few more minutes to talk about
Absolutely.
these, or do you need to run? I thought, like, one of the comments, you talked about used car prices falling and like the implosion of Carvana, which I never understood Carvana. I mean, I looked at like a giant vending machine with cars in it. But maybe talk some about that if you want to riff on it a little bit. And then also, I'm interested in the Disney stuff that's going on. I don't buy a lot of individual stocks. Disney's one that I had for a long time and sold it for, I should have sold it earlier. I had a little gain on it, but it had tanked, somewhat recently before I sold it. But that's, stuff going on there is also interesting, and the streaming wars and all that stuff. But just any tidbits from things or research that you've done on some of these more miscellaneous stuff. I love reading those notes, and I'd be happy to hear it.
Well, thanks for saying that. Those are some of the most fun that I have to kind of just steer my effort towards something completely, out of what I think about day to day. And the used car thing, again, I think it's very interesting because it gets back to this first order thinking. So used car prices spiked going through the pandemic, right? Because we have this huge supply chain disruption that makes manufacturing new cars really difficult, specifically because we don't have the chips that we need to
right.
Have the new cars function the way we need them to. So used cars are at least available, and so the demand for new cars that no longer exist gets shifted into used cars. So used car prices start spiking, and we're at home, and so again, there's we have this decade coming out of the financial crisis where interest rates are pretty much at zero. And so this idea of investing for super long time horizons makes sense. It's exactly what you're talking about when you don't have, an effective risk-free rate that can help us understand the merit of different investment opportunities. It's very easy to make investments that aren't justified in more normalized rate environments. And so you have this combination of used car prices spiking, interest rates set up where we can invest for the long game, and we think, okay, we're going to have this digital disruption of how we buy used cars. And the play was, okay, if we can make this digital environment where it's even easier to go buy and shop and find the used cars that you want, and then we'll go buy a bunch of used cars so that folks have to come here in order to get it. They'll like using the system, and we can be the one-stop shop for the used car environment. And to first order, all of that stuff sounds plausible. But the moment that you start getting where the lockdowns go away, where the supply chains start to normalize and you get new cars again, where interest rates start going up because you're fighting an inflation issue, and so now you can't just execute these land grabs in a digital world where we're just going to go find as many customers as we can find, regardless of what it costs or how long it's going to take to monetize these customers. All this stuff happens like in the course of 18 months, and now Carvana's on life support. And so and again, it's not that these people are stupid or lazy. It's just that the incentives that existed in the economy and a narrow enough view of what the macro economy looked like would have led you to believe that, of course we should be doing something like this. Zoom out far enough and you realize, man, that just doesn't seem, it's one of the many reasons I just never got that into it. It certainly struck me as just being something that was at best a bad, at worst sort of a transition into some new normal, but that just didn't seem like the final answer. And so sure enough, today, used car prices are plummeting, and Carvana's stock is down massively. I forget the percentage point, but 90%, something like that. And so incredibly painful lesson. So I write about that not to rub it in. I don't like to be that guy that's just out there kicking people in the teeth when they're making silly investment decisions that end up biting them in the rear end or whatever. But I do like for people that are reading this to think through, when you're making these longer term capital allocation decisions. We saw it at Peloton, the kinds of investments that were made in the midst of a pandemic, where these long term trajectories change materially very rapidly coming out of a pandemic. And so I think there's just more. It's a message of making sure that we're introducing the right kind of risk, the right kind of perspective, and deliberation when we make these long term capital investments, because when you don't, you can wind up in a space like Carvana where you're getting kicked in the teeth. The other one, like you had mentioned, and it's one I've visited a couple times in my research. I guess just because I'm a sucker for it, is specifically the Disney versus Netflix comparison. And so we have two young boys at home. So Disney is an important feature of our lives at the moment, and has been for years. I remember my son, long story short, I won't go through all the details. He's fine now, but he broke his leg right before his second birthday, and it was super scary. And it was unfortunate. He's fine now, but so he broke his leg, so he needed to kind of chill out for a while. And so if anyone asks me, what movie have I seen the most from start to finish in my life, there's a number one answer, and there's just a huge gap to number two. And number one is Finding Nemo. We watched Finding Nemo, at least 50 full times, maybe 100 full times. And he called it Momo. So he's like, what do you want to watch? And he's like, let's watch Momo. Okay, we'll watch Momo. So I've watched that film, like I said, 50 times, whatever. So I've been deeply into Disney and just seeing the magic. I mean, it hooks kids. It pulls in families. Like there's real value to that brand and those characters that they're building. And then when you start diving into Disney Plus, it's like, okay, that's fine. And all that stuff matters. The brand matters, the character matters, all that. And yet the streaming wars are incredibly intense. Netflix obviously had the first mover advantage and executed a pretty serious land grab that's difficult to go capture from. But it's happening. Like when that piece of territory is that fertile, folks will go attack it. And so Disney has. And what's interesting to see is Disney is spending about what you would expect to spend in order to build up a streaming infrastructure to serve the audience that it has. And it's spending on par with Netflix. It's just not monetizing it nearly to the degree that Netflix is. And so it's just running billions of dollars of annual losses, whereas Netflix runs, $1 billion, $2 billion, $3 billion of annual profits. And yet even Netflix, right, at those profit levels is talking about the revenue leakage that it sees because people aren't paying for their own accounts or sharing accounts and all the rest. And so the streaming space interests me a lot because clearly there's an enormous demand. It's a very important source of entertainment for a lot of people. And yet, given the cost that it takes to build that out, which will only increase now with interest rates being higher and labor being more scarce and everything is being more expensive, it's going to be more costly to compete in that space. There's real urgency to figure out the monetization side and how many of these subscriptions will people be able to carry simultaneously. That's a battleground that I'm just super interested in. So I've been diving a lot into that one.
It is interesting. We talked a little bit before we came online about content and people's attention spans. And, there's only 24 hours in a day. You're only awake for, half those hours, roughly, maybe a little more. And you've got all this stuff vying for your attention, vying for your time. And this podcast, which is relatively small, although I think according to the analytics, it's like in the top 1% of podcasts. I don't get a lot of views. I think that's just because there's like a ton of podcasts out there. But like even this podcast just on YouTube, and YouTube is probably 10% of the viewer listenership. I mean, I get thousands of hours annually of watch time. And that's kind of crazy if you think about it. I mean, it's days and days and days of people watching it. Or if you look at it even at a smaller scale on like these clips that I was talking about, post like a 50-second clip on LinkedIn or on TikTok or Twitter, and it's getting 7, 8, 10 hours worth of watch time for a 50-second clip. And you think about the type of creator that I am so small compared to the biggest creators who are getting, probably tens of thousands or hundreds of thousands of hours, even monthly of the watch time. And their cost to get into access it, to build like a podcast studio, if you want to have a really nice one, it's a couple grand. 20 years ago, this would have been a $30,000, $50,000 studio, lighting, cameras, all this stuff. Now you can get it for a couple $1,000s. And so the barrier to entry in the content space is basically zero. And so many people have a desire to consume content, and they want all different kinds that, man, when you look at like the big budget, high production value content that Disney and Netflix and these groups are doing, and the billions of dollars that costs them. And then now they're competing with, some guy sitting with a Sony camera that can, hijack those eyeballs. Even if it's just for a fraction of that time, that is time that, people may otherwise have spent streaming something or watching a documentary or whatever. It's like if they wanted educational stuff, the only way you used to be able to get it was to watch big budget documentaries or something like that on National Geographic or whatever. And now you can get on YouTube and watch pretty much whatever you want. And I found myself spending more and more time watching YouTube versus the mainstream streaming services. Like I get on and I watch YouTube, I listen to podcasts. So it's not a business that I would be envious of in terms of the large scale streaming stuff. I just think that, man, that is just such a capital intensive, low barrier to entry, knife fight of an industry to be in. It's a fascinating one to watch because I don't know where the end game's going, but it doesn't look good. It looks really difficult for these people.
It does. And what it's to call back to the early part of the conversation, we said real stuff matters. This is something else I thought a lot about as my career has progressed is the attraction that technology has had for intellectual capital around the world, but certainly in the United States. It's had more than its fair share of high capacity folks over there deploying a ton of brain power solving those kinds of problems. And so what you said there at the end about the capital intensity, the resources that are being deployed at trying to fight that battle between the financial resources and the intellectual resources, because of how sexy that space is. Again, when I have early career folks that are talking to me, it's one of the reasons that I do say energy is such a great spot to be. Or even for a while, I was big on the water and wastewater side because I just interact with a lot of folks in that industry. And it's like, man, there's so many interesting problems to solve in energy and in water and in any of these sort of real tangible industries that live further afield of technology. And there's a relative scarcity of capital and of high bandwidth folks that are pursuing that kind of stuff. That, man, you have enormous opportunity to go make an incredibly valuable contribution over there. So it goes both ways for me. One, it means that like when the Disneys and Netflixes of the world duke it out over something like streaming, it makes good theater for me from outside looking in. But I think it also introduces and opens up a lot of opportunity for the rest of us that aren't just get drawn out into technology. That's like, man, if you think hard and go off the beaten path a bit, there's incredible opportunity out there to go explore.
Love it. That's a great way to end it. We could keep going. There's so much to talk about, but Jeff, thank you so much for coming on. Where's the easiest way for people to follow your work that you do?
I would say find me on LinkedIn. My name is Jeff Krimmel, Krimmel. I'm posting stuff. I try to post every single day over there. So that's probably the easiest place to get a hold of me.
Absolutely. Thanks, Jeff. I really appreciate it. This was a fun one.
Thanks a bunch, Max. I really appreciate you inviting me on.